Good morning, Pete.
Good
Welcome
morning,
to
John.
the first session of It's Your Money for the spring of 2023. And let me just show a screen here for a minute and we'll go through that and then we will move on. So I want this guy. And I always tell people, I look back and forth because I have a laptop over there that's logged in as a participant, so I know what's going on. So we're doing the first session today. There's a handout that is also a handbook rather that is available to you. And it's not meant to be, here's a guide of how to do these things. It's sort of a follow on to where we are. A lot of times when you have different people presenting over 6 weeks, there's a little bit of disconnect at times. So I said, let's put all these things together. So the workbook itself is available to you on the website. So you can go download this at It's Your Money. I'm sorry, IYME, It's Your Money and Estate.org will bring you in. In fact, let me show you that. If I switch this, since this is our first week, we're working here at figuring out all of the pieces we had to remember we were doing last year that we don't remember how to do. So if I am correct, that is the website. Hey, got there. So if you go to IYME.org, it's a lot smaller than this long thing you see up here because we realized It's Your Money and Estate.org is tough to type. So if you come into the website, come here, if you click on workshops, you can come down and we're doing It's Your Money. And as a note, so each time we go through these are the handouts for today if you want to have a copy of it and print them out. There's also the workbook is here if you want to see that. If you want to go look at these estate sessions, you can look at those also, but all of that information is right here on the website. So that's the best place to get things and you can print them out as you wish and use those. So let me actually just stop sharing, bring us back here. And so Pete, I'm going to suggest that we have Delia come on in.
Yeah, come on in, Delia, because you're, as I've mentioned before, Delia is
You're doing it. Yes.
Yeah, is our fee-only fiduciary financial advisor, and she is the first person that I went to when we did the very first workshop. Over
and Pete,
20. Yes.
Pete, let me stop you for just a moment, because since this is our first one, I need to say this again. I'm going to go away, and what I'm going to do is I'm going to monitor the Q&A questions that might come in. So as those come in, I'll either interject them as we go through or make sure that we cover them somewhere along the way, or if I know the answer already, I'll answer the question. Okay. And so we'll be doing that, and then I'll be around listening and paying attention, and I get to be the voice of God coming in from the background and asking questions as we go along. Bye. Great. Good to see you. Okay.
Bye, Don. All right.
Hey, Pete.
Hello, Delia. Getting warmed up. We'll get into the meat of the program in just a little bit, but just a little bit of introduction. This is the anti-free lunch, free dinner program. And what we mean by that is that many of the programs that you can go to quote unquote, learn about something financial are selling financial products. The financial services industry is very close to being like I'm going to say a used car lot. There's lots of things in the car lot that you could sell, and we have a whole program of what those products are: annuities, mutual funds, partnerships, and individuals who are selling these products earn a commission. So it's not that much difference than selling a used car. I just have a real deep aversion to giving my money over to someone who is going to sell me a product instead of helping me determine what's best for me. And that's what fiduciary means. And so one of the things that shocked me when I was at Long Beach State University, and I went to very intelligent individuals, and I asked them, why did you choose the financial advisor that you have? Many of them did. because their passion is education, not earning monies as a business person. And they said that was the nicest individual that they've ever met. And I've never met a salesperson who was not nice. So there's has to be a little bit more. And what I found too is they didn't know what questions to ask as to how to find a financial advisor. So what we created, or what a gentleman by the name of Ed Long, who started a program called Help for Seniors. And he designed the primary outline of the Ask First form. And so, Delia, could you possibly put your Ask First form up on the screen?
Will do. That Help for Seniors group is a great group.
Yeah, lots of great information. This is a one sheet page. First of all, was this strenuous for you to complete, Delia?
No, very easy.
Okay, so the first thing is I request, what is your education?
Yes, I've got my college undergrad, plus I got my MBA from Cal State Long Beach.
Okay.
Not to mention the CFP designation.
Yes, and we'll get to that in a second. The second question is credentials. What credentials do you have?
Well, as I had said, I got my MBA at Cal State Long Beach. I then went to UCI and received the training needed to sit for the CFP exam. And after having the years of experience, and
what's CFP stand for?
That's Certified Financial Planner.
Okay, and talk to me a little bit about because there's probably 120 or more designations in the financial services industry. Where does CFP fall in?
Well, CFP has become probably one of the most recognized designations from the certified, from the board of certified financial planners. It is a program of about 2 years worth of classes, 8 classes. It is an exam, and it has a component of experience. So education, you have to have an undergraduate degree. You have to go through their program. You have to sit for the exam, and you can't use the designation until you've had 3 years of experience or comparable experience in the industry of helping individuals with their finances.
And then it says here that you have 29 years of experience.
Yeah, it keeps growing. It's impressive. But yes, I've been a CFP, been registered as an advisor, have been registered as an advisor for 29 years.
Okay, and you also teach it. Those are just excellent credentials. Now, people get confused between a credential and a license. In financial services, it's very confusing. You're a registered investment advisor, and that's what RIA means.
That's right. And it's not a license per se. It means that I am registered with the state of California, who is my regulator, to be allowed to do this kind of work.
Yeah. And in order to get a license, or a registration, is there any college education required?
No, typically you may need to have passed a securities license exam, which doesn't require an undergraduate degree or other education.
But in
and
fact,
you fill out a form and pay a fee.
Yeah. Most individuals in the financial services industry on the consumer level are hired based on whether or not they can sell.
Yeah.
They're not hired, and the licensing is very similar to a real estate license. You know, there's not a high level of knowledge that you need, because they're trying to, the SEC and FINRA, and we'll get into that a little bit more, they're trying to regulate ethical sales behavior,
Yeah.
not competent financial advice. And so the whole philosophy on licensing is that if you as a reasonable consumer have full disclosure on the product or on the person, then you as a reasonably intelligent individual can pick whoever you want. I disagree with that philosophy, but that's the overall writing philosophy of the program.
Well, it's
So-
really buyer beware, isn't it?
Yeah, it is. And so what do you have to hand individuals when you first do business with them?
Oh, I have to give them a disclosure document called Form ADV, which tells, boy, it has so many details, my education, my experience, the hours of operation, how I do business, what I charge, how I charge, any kind of regulatory information about, you know, have I ever been arrested? Have I ever been convicted? Have I ever had any of these problems? Do I have current lawsuits against me? I mean, lots and lots of disclosures.
Yeah.
It's really ideal. You want to know that about a potential advisor, especially if they're going to manage your money.
Exactly. Why don't you scroll down a little bit further? It says you do not practice law, but you review a person's estate plan as part of the financial planning process. Is that correct?
Yeah, I can look at it. I would not look at it to say this legal clause isn't accurate or up to date, but I would say, are these the people you want to leave money to? Are these the people who should be in charge? Are these the kind of powers you would like them to have? This, I may flag something for them to talk to their attorney about.
Yeah. One of the things that we're going to be talking about is what is the difference between you and a broker, and what is that financial planning process? But we'll get there just a little bit, because the next question is also one of the most important. In our business relationship, will you at all times serve as a fiduciary and put your interest before my interest and those of my employer?
Exactly. That's exactly what I'll do. And I'll tell you, Pete, I'm a career changer into this industry. I became the kind of planner I thought I would want to hire if I ever needed to hire a planner. And I thought, well, instead of hiring one, why don't you become one? That's what I did.
Yeah. And the thing of it is that 80 to 90% of the individuals that are on the consumer level would have to put false on this business relationship, because they don't work for the client. They work for the Merrill Lynch. They work for the Morgan Stanley. Morgan Stanley pays them. UBS pays them. And you, as the consumer, you pay Morgan Stanley, UBS. And so they don't have to put the client's interest first, and it's your money. What a system.
And what a great name for a program, because
it's
your money.
That's how we got the name.
And that's what we're trying to tell everybody. This is your money. Pay attention.
Yes, not Merrill Lynch or UBS or Bank of America. Compensation. How do you charge? That's one of the most important questions.
I charge in one of two ways. I either charge, it's always fee only, directly from my client, not from anybody else. I either charge hourly for financial planning advice and investment.
And what is that hourly rate, Delia?
$350 an hour.
Okay.
And then some people would like me to help them in managing their money, which means the money would go to TD Ameritrade, soon to be Charles Schwab. I manage it, invest it, charge them in arrears every quarter at the end of the quarter. And that starts at around 1% of assets under management for the first $500,000. But that includes financial planning assistance.
Oh, it does.
Yes.
Okay.
Yes.
So on the face of it, it seems like you're much more expensive than a Merrill Lynch or a UBS advisor. By the way, I don't like to call them advisors because they're selling stuff. So I rather call somebody who works for a Merrill Lynch, a B of A broker, because they earn their monies not based on just advice, but they base their income on commission income.
Yeah, you'll find a lot of advisors who have changed careers. They may have started on that side and then they realize what they really want to accomplish in their career. And they'll say, well, I want to work on behalf of my client. And they'll leave those organizations and go out on their own.
Yeah. So the typical brokerage client is usually paying somewhere between 1% and 3%, depending on the type of plan that they have. Is it easy to figure out what under a brokerage plan, what you're actually paying?
It can be really difficult because you have to know what to look for.
Yeah.
You know, a client may have an investment account and they say, well, I'm paying something for investing, but then you look at the portfolio and you see they may be paying an ongoing fee, but they may also have higher fees inside the investments themselves. And oh, look, there's an annuity for part of their money. Why did they get that annuity? They don't know. What are the fees inside the annuity? They don't know. What would it take to get out of it? They don't know.
Right.
So a lot of costs that are not as clear as they should be.
Do you give or receive referral fees?
No,
Do you sell insurance products?
no.
Okay. So sometimes people need insurance. What do you do?
I have a group of insurance experts I send people to. I may work with those advisors directly to coordinate for my client, just as I would contact and coordinate with a client's CPA or accountant or their estate planning attorney.
Are there a lot of conflicts of interest in the financial services industry?
Well, there certainly can be. I mean, if you're getting paid a bigger commission to sell product A versus product B, maybe product A just looks like the best product today to sell, right?
Yeah. Yeah. Look at that Mercedes. It's got that extra beautiful whatever.
And, you know, I've even had students of mine who work at credit unions say that they've been pressured to sell certain annuities and other products. And it's a heartache because I love credit unions. And I hate to think that some of their employees may have this conflict in what otherwise would be a really nice way to serve the population.
So one of the most important questions to ask first is, how are you paid?
Yeah, exactly.
And where does your income come from? And that's the next kind of question. I offer or sell annuities, insurance, mutual funds, or other financial products, or my employer, or am I affiliated with a person or organization that sells annuities, et cetera, because it's the free lunch and the free dinner. It's all about selling stuff.
Yeah.
And boy, that's not what managing money is all about.
And that's why you want to look at the potential advisors' disclosure documents to see, are they working for themselves or their organization that's fee only? Or are they working for somebody else and they're going to be, and there'll be comments in there, you know, authorized or licensed to sell these products.
Yeah. We are not going into this amount of detail with all of our presenters, but this is the first time that in the first session, I want you to, how long, by the way, did it take you to complete this form?
It was so quick. It was so quick.
5 minutes, 10
5
minutes?
minutes.
Yeah.
Then I had to print it out, sign it, and scan it.
Yeah. When you say you certify under penalty of perjury, what is, does that have any meaning?
Well, it does to me.
Yeah.
I mean, because again, I went into this business and I hold myself out as fee only. I belong to a fee only planning association. I tell my regulator I'm fee only. This is how I work.
Yeah.
And this is who I am. So this means an awful lot to me.
Well, not only that, but it has immense amount of legal liability.
Yeah.
If you were to be somebody else than what you portrayed to be in this form. So it has some significance even on the legal end. Okay, Delia, we've gone through the Ask First form. Let's go to the program.
Okay. Well, it's your money. It's your money. And so Pete, today, and here's the handout that would be available on the website, also has my contact information. We want to talk about the regulation of the investment industry.
Yeah, we're still on your Ask First form.
Oh, I apologize. I thought I'd switched it over, but thank
See?
you. I
The
appreciate
voice of
it.
The
God.
voice of God
The
speaks to the
voice of
visual.
God showed up.
Oh.
The voice of God showed up. I appreciate it. So it's your money.
There you go. Good.
It's your money overview and tax changes. And this is my identifying information, contact information. You're welcome to reach out. Today's topics are a combination of the regulation of the investment industry, which we've already started talking about a bit, what's new for 2023, and how to start putting that into context of the financial planning process. We're not going to talk about the whole financial planning process today, but we're going to touch on it because these all work together. These all work together. So, Pete,
Yeah.
we've been talking about this. There are independent advisors or those associated with brokerage firms or what we call broker dealers, those organizations that stand between an investor, a buyer and a seller.
You know what? It's so similar to the real estate industry.
It is, isn't it?
If you're an individual that works as a real estate agent, your broker could be First Team, Caldwell Banker, etc. And when you sell a house, part of that commission you keep, and part of that commission goes to your broker.
That's
And
right.
The financial services industry works exactly the same way. But they don't want to be thought of as salespeople. They want to be thought of as a advisor. And so therefore, you have all these designations in the industry because most people don't know what it means. But hey, if you got all these designations, you must be an intelligent and competent individual. And most of them you buy as far as the designation is concerned. There's
Might
no
take a
extra
few
work.
hours to go to a classroom and then you get the designation, you pay a
Yes.
fee.
So you're called a registered representative, and if you're independent.
If you're independent like me, then you are typically registered to be an investment advisor, and so you are considered a registered investment advisor.
How are all these compensation methods?
It gets very confusing. The commission only tends to be the model for people who are selling product only. That kind of has mutated or progressed because a lot of those people in that part of the industry also like to receive steady fees. So they may charge a fee plus a commission, or they may say, if you buy this product, I'll offset my fee with a commission. And they may call themselves fee-based, but that can mean that they also receive a commission. There's only, and this has become very important and sensitive in the industry, fee only means fee only. I only get paid by my clients.
And so therefore your only obligation is to the client.
That's exactly right. That's exactly right. That's my only obligation.
Yeah.
And
that's why it's so important to ask, how are you paid and by whom?
And how else are you paid?
Yeah.
And how else are you paid? And
Yeah.
see if there's any other information that they finally give you.
Yeah. Next.
So we've been talking about this credential. I talk about an individual being a registered investment advisor, but technically from the standpoint of the regulator, it is my firm that is the registered investment advisory firm. And in my disclosure documents, I am the investment advisor representative of my firm.
Right. And it's not a credential.
It's not a credential.
No.
Certified financial planner, we've already talked about. There's a chartered financial consultant that came out of the insurance industry. Chartered financial analyst is like the PhD of investing. And I think of that because it is a several part exam of 3 parts, three exams to be able to receive the full CFA designation. I have a lot of respect for those people. They've taken the deep dive just on the investment side.
I find him akin to a CPA, also akin to most of your CFAs are ahead of a mutual fund. it's a deep dive, as you said, and they go into a stock or into a company and they go a mile wide. I mean, a mile deep.
They tear it apart.
They tear it apart.
They take
Now,
the annual report and they start at the back, they tear off the
Yeah.
front, and they only go through the numbers, you know?
yeah, and the CFP is a mile wide.
Yes.
You know, it's almost like in the medical industry, I would say a CFP is like a general practitioner.
And we often think of ourselves that way because, just as I had mentioned earlier, I'm looking at the big picture and saying, you know, we need to pull in your accountant. We need to pull in your estate planning attorney. We may need to consult with a
An
good
insurance
agent.
specialist. you know?
Exactly. Exactly.
Yeah, but you're the overall check the pulse. How's the blood pressure? You know, how's your cholesterol?
That's it.
You know,
That's it.
how's your wrist doing? Do you feel good? What about being an advisor is not just about the investment.
Oh, no, it's not. It's not. I find one of the first things I talk to people about is protecting themselves with having sufficient auto and homeowners insurance. Well, I certainly wouldn't, you know, I don't sell auto and homeowners insurance.
Yeah.
But if you've got something to lose, you have to have good insurance to protect yourself.
Experience is important.
I think experience is important. It's just like a physician. You know, have you seen this before? Have you heard of this before? Experience can be not only seeing it one-on-one, but talking to colleagues, having that, you know, group of colleagues that you talk to, professional associations, extra training that you do.
Yeah.
Those of us who are in the business tend to just love all of this and are fascinated by all these details.
Yeah, and you know, and I want to just if you have a young CFP, there's nothing wrong with that as long as the young CFP is in a group where there's some experience, because they're going to go back and talk to the senior advisors in the group to say, hey, this is the situation I have. What would you do? So a lot
And
of
that's
times,
our responsibility as a fiduciary, is if we don't know something, we either have to refer out or consult with an expert. That's our jobs.
that. So explore. Just because they're young doesn't mean that they're not good for you. How much effort are they willing to put into your case? Dealing with money is how many clients can you have, Delia?
Well, you can't have an unlimited number. I mean,
No.
I'm a sole practitioner. I manage money for about 45 families or entities, and I may see 2 or 3 hourly clients a week.
Yeah, it's not something. The average broker has somewhere between 1,000 to 3,000 clients. There is no way that you can service that many clients unless you're just selling product.
Yeah,
And you got one size fits all.
exactly.
And we're all, I work with a lot of families, and there's no two people that are exactly alike. We all have different risks. We all have different biases. We have different quirks. We're kind of a weird group of animals. Rapport, trust. Why is that important?
Well, it's just like choosing a doctor. If you feel that you can't talk to your advisor about what is really important to you, you don't have enough of a relationship to really sustain that relationship over time.
Yeah.
You want to be able to tell your advisor, this is what I want to do with my money. This is what I really care about. Yes, I want to give to charity. This is one of my big priorities. Or no, I really don't want to pick for my kids' college after their undergraduate degree. Or gee, I really have to support the family back home. If I don't know that, I can't plan for that.
Yeah.
Don't
I would-
pretend to be something that you're not. I need to know who you are.
Yeah. You need to be able to talk about death. You need
Oh
to
my
be
gosh.
Yeah, we need to be able to talk about what is your fears about money. I mean, death and money probably are the two most difficult things for a family to discuss. And most individuals, married couples, if they get divorced, it's over money.
Yes, and it is going to be also a reason why people will call a planner on an emergency basis. You know, my father just got this diagnosis. My mother doesn't know what to do.
Wow.
They may call us before they call their estate planning attorney.
Yeah,
you
I
say,
make
how are we
that
gonna manage
recommendation all the time. Call the fee only. It's a predatory world out
Oh.
there. And when you lose a loved one, the last thing you want is to be in the hands of a salesperson. I know they were nice, but that's not somebody who's going to do what's best for you. And I say that reluctantly because there's some individuals who are commissioned individuals that will do the best for you. You know, they're just ethical individuals. So,
But somebody
General-
going through that is under a lot of stress. I always encourage them to not only come in, but to record a session, to bring somebody with them as an extra set of ears. We'll take notes during the session that we all look at together on the screen. And we want to first do no harm. We want to protect them, do what they need to do, but not talk about anything extra.
yeah. By the way, since you're not licensed, you don't have a Series 7 license. Are you even allowed to sell financial products?
Yes, I'm allowed as a registered investment advisor to have.
I mean, to receive commissions?
Oh, to receive commissions?
No,
No.
you can't. So if you had a license like a 63, a 7 or one of the others, that would be kind of a cautionary sign that you could sell products.
Well, it might have been, depending on where somebody is located and how long ago they registered as an advisor, it might have been one of the criterion or requirements to actually register as an advisor.
Okay.
But it would not, if you didn't have a relationship with a broker dealer where you sold product, then you wouldn't be allowed to do that.
Let's go to the next slide.
Okay. We all love regulators. We all have regulators for in business. And the big one is the Financial Industry Regulatory Authority, or FINRA. And this is self-regulatory organization for all US securities firms. And for any individual who sells securities, they have to register with FINRA under the sponsorship of a broker dealer. So that gets back to that traditional role.
And so anytime somebody comes up to you and tries to indicate that they're a financial advisor, the first thing you'll need to do is Google broker check.
That's right.
And that'll lead you to FINRA. And again, it's that philosophy of full disclosure. And you want to check them out. How many years that they've been in the industry? Do they have any disclosures, etc.? But broker check goes through FINRA. And FINRA is Merrill Lynch, broker, Bank of America.
But it's also
Stanley.
a little confusing because you can also access a registered investment advisor firm or advisor through that broker check.
Yeah.
But that doesn't mean that we are registered with a broker dealer. So it'll have a separate kind of disclosure.
So SEC, what is that?
That's the Securities and Exchange Commission, regulates the securities industry and all those registered investment advisors and firms with more than $100 million under management.
And in California, what does California do differently?
California is very similar, but they take those advisors with less than $100 million, and they have their own set of regulations that's very similar to the SEC.
Yeah. Check if you have not checked your individual advisor on FINRA, please do so.
Exactly.
It's amazing. Sometimes people call afterwards and say, hey, I help them find the advisor, and they have a multiple disclosures. It says, oh, this particular individual been with the family for I don't know how long. I just met with an individual the other day that had 24 annuities. Yeah. And he called himself a financial advisor. So be careful.
It was an annuity salesperson.
Yes.
That's crazy.
Yes.
So you've already talked about the importance of the Ask First form, where you want to know their education, their credentials, if they have any licenses, what services they provide, but most importantly, are they acting on your behalf?
Yeah.
You know, are they going to put your interests first?
Yeah.
And how do they get paid? And that will be a clue. That's a big clue. They get
Huge
paid
clue.
to sell product. Yeah.
Yes. Let's go to the next slide.
So what a financial advisor is going to do is they need to understand this is a financial planning process. They need to know the client's personal and financial circumstances. We need to know your goals and objectives and how to prioritize them. What's most important to you? Then we can analyze a course of action that'll help you meet your goals and objectives. We develop some recommendations and alternatives because there might not be just one way to take care of your goals and objectives. We present the plan, we help make it happen, whether it's investing your money or whether it's referring you to an accountant or an attorney. And then we should be monitoring and updating and adjusting your plan as time goes along.
Give me a timeline as approximately how long this takes.
You know, the financial plan, depending on the complications of the client and the time that the advisor has available, could certainly take 2 or 3 weeks of gathering data. That's the big part of it, because clients want answers to questions, but we need the data before we can formulate those recommendations.
Yeah.
So
I find a lot of times it takes a year or two sometimes to get information and also to identify the goals, to identify the risk level that the client can take.
really get to
Also,
know the client.
yeah, the rapport, it takes a while. So
And for the client to sit with the advice and realize how the process works and then say, oh, well, what if I could do this? You know, once they start thinking about that mindset, it takes a while for them to understand the tools and techniques and methods. And then they say, is there something else I could do to accomplish this that would be faster, easier, or more efficient?
yeah, yeah. And especially for individuals who are about to retire,
Oh,
you know, how much income do I have? And there's all sorts of stress involved because now that you're not an employee any longer.
there's not that paycheck coming into your checkbook. Where's the money coming from?
Yeah.
So clients will ask me, where's the
And
money coming from?
taxes
And
plays
taxes.
such a huge role.
And they
So
spend all their time putting money into a retirement account and now they have to take it out.
yeah,
That's scary.
and things are not simple.
No, they're not.
They're just not. I mean, they're very complicated. Let's go
Which
to
is
the
what we
next.
want to talk about too, when we talk about taxes, because that's
Yeah,
certainly a
we'll
big
get
part of
there.
it. So to start with the financial planning process, Pete's always telling everybody you need to know what your net worth is.
Yes.
You know, what do
Before
you
I go out to
own?
lunch with them, before I create any kind of friendship, I want to know your net worth.
Yep. What do you own? What do you own? What categories do you own it in?
Yeah.
Who owns it? How's it titled?
It's amazing to me the number of people who have no clue what their net worth is.
But
Or
we have to start here. We have to know what we're protecting. We have to know what you have to work with for retirement or to accomplish other goals.
don't have it written down, or have a kind of a sense of what their net worth is, but they don't really understand it. You know, so because hey, when you're in your 20s, 30s, 40s, and 50s, maybe, and you have kids,
Yeah.
everything kind of goes out, you know, you haven't saved a lot.
Everything's
So
going
it's
out the door, but you're so busy you can't even concentrate on
Yeah,
these details.
yeah. But the last thing we're going to be talking about at Thanksgiving Day dinner is, and sis, and what's your net worth today? It doesn't call for a happy dinner.
Now that'll stop a dinner.
So, but it's so important. Everybody should have a net worth statement for themselves.
Yes.
Let's
See if
go
you
to
can
the
update
next.
it
We're
at
going to get
least.
into more detail next week.
Yes, you will, definitely. So just to mention that tax planning, because I want to talk about some tax issues. that these financial strategies are based on your tax profile. Is what income do you have? What deductions do you have available? These days, can you itemize or can you just take the standard deduction? Because the tax laws changed in 2018. 87% of the people no longer itemize. And I still have people who come in and say, I don't want to pay off my mortgage because I get to deduct the interest. And I look at their tax return, they can't deduct the interest. They haven't been deducting the interest.
Yeah. Or
didn't
they
realize
invest in tax-free bonds and you know, and there's no reason for that. They should be investing in taxable bonds. By the way, everybody who pays taxes believes that they're paying too much.
Oh, that's absolutely.
It's nobody likes to pay taxes.
Absolutely. So this is a formula that I grabbed and realized that it needs to be a little bit updated, but basically the IRS wants to know all income from all sources worldwide. So this isn't you exclude income that comes from your former job in England and a pension. No, 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 all income worldwide. There might be some exclusions, such as tax-free income from tax-free bonds, maybe some business things that we exclude. And then we've got your gross income, and we may adjust from the gross income. And these adjustments may be a lot of business expenses. If you run a business, they could be contributions to retirement accounts. So we take adjustments from gross income, and then you may or may not get to itemize, or you take the standard deduction. We no longer have personal exemptions. We have standard deduction or itemization. And then you've got your taxable income. And now we have to look at that taxable income and see if there are any other credits that we can take, or tax credits, and whether we owe tax or whether there's a refund that's due.
What is the difference between a credit and a deduction?
Oh, a deduction may reduce your taxable income. A credit reduces what you owe in taxes. We love credits.
Credits is a dollar for dollar.
Dollar for
reduction.
dollar.
The-
Dollar for dollar. And if it's a refundable credit, it means that you get that money back from the government, even if you didn't owe tax that it could be used against.
Okay. And the deduction is just reduces your taxable income.
That's right.
Do you have let's go to the next slide. Do you have okay, good. That's
So
what I
this
looked
is
at.
what the standard deduction looks like for 2022 and 2023. And like I said, a lot of especially my married couples will come in and say, well, I want to deduct this mortgage. I don't want to pay it off, if it were even a thought that they could pay it off. And they don't realize they already walk in to 2023 with a standard deduction of $27,700.
So you would have to have itemized deductions that exceed
That's exactly it.
$27,700 before you can even consider it. So the fact that I'm saving receipts for donations to Goodwill probably is a waste of time.
You know, you still should have them, because you don't know how the year is going to turn out. What if
But
towards
it
the end
doesn't
of the year,
exceed, it definitely doesn't equal 27,700 and my mortgage is limited to 10,000.
yes,
So there's no way that the standard deduction makes my tax tax analysis pretty simple.
it certainly can. It definitely can. So once you figure out your taxable income, then you look at where you are in your tax rate. What we call your marginal tax rate is a progressive system. So it starts with a single filer, and you can see that the starting range is at the 10% marginal rate. And then the next level from 11,000 to 44,725 puts them in the 12% marginal rate, 12% on the excess of that income, and so on to the 22, 24, et cetera, up to the 37% rate.
So if somebody's doing this themselves, you know, with investments and TurboTax and et cetera, they need to understand their net worth.
Yes.
And they need to understand their marginal tax bracket.
That's exactly right, because the next place that you invest $1 outside of a retirement account is going to fall right into these tables.
Yeah, because
Right
if
into
you're
these tax tables.
if you're in the 35%, I'm just using this as an example. If you're in a 35% tax bracket, that does not mean that every dollar that you've earned of 231,000 is being taxed at the 35% level.
That's exactly right. It means the next dollar that you make, if you're in the 35% marginal tax bracket, the next dollar you make is going to be taxed at 35%.
And this makes a huge difference when you are paying Social Security, or whether or not you're going to pay taxes on your Social Security, Medicare payments. It's
Oh my
really,
gosh.
really important there. So understanding your marginal tax rate is like your net worth. It's another one that you should know. It's kind of like you should know your weight. You may not want to. I try to avoid it, but it's important. You need to know your blood pressure. You need to know your heart rate. This is the kind of thing that if you're going to do your own financial stuff, this is the stuff you need to know.
That's right. These are the financial basics on your profile. Who are you? And this really does bring people into focus as they get ready to do retirement planning. So where's the money coming from? How's it going to be taxed? How else is it going to be taxed? What do you mean my Social Security is going to be partially taxed? Oh, no.
Yeah.
So this, and you have to know what category you file in. Now, if you're married, filing jointly, that's pretty straightforward. Or if you're single, but are you head of household? Are you married, filing separately? This has a big implication for your tax situation. And then the good news is that if you have some money outside of retirement accounts that you're investing, you have a great opportunity to actually harvest some money out of those accounts and have more favorable tax rates on that income if you actually held something for a year or more, and it can therefore be a long-term capital gain. Or if you have a stock that issues what we call a qualified dividend, and this is on the federal level, is taxed at a more favorable rate.
So
California
the previous
considers it ordinary income.
So ordinary income, we had rates up to 39%.
Yeah, that was up to
37%.
37%.
So the maximum on the capital gain is 20%. Well, that is huge.
Huge difference.
You talk about money putting to your pocket. So when you put a portfolio together for someone, you try to put a portfolio together of capital gains.
Boy, I really try to put a portfolio together where we are balancing losses and gains. We're watching how that's all working. We're making sure we understand if the client needs money. And last year when we had some losses, some people had losses, maybe we take advantage of those losses to sell some things and lock them in so that they can use them in the future, which just sounds counterintuitive, but was making lemonade out of lemons.
Yeah. Yeah. So taxes, your fee is 1% of the portfolio. Just in tax area alone, that value can be doubled or tripled.
Yes, if we can plan to have some money outside of retirement accounts, we can use that pot of money to not only grow for the long term, but harvest that for other things that you need to do.
Yeah, I don't find very many brokers doing this kind of planning for individuals in the financial planning process. And if they're not, you're losing out.
Yes.
You're leaving money on the table, as they say, that they're not putting in your pocket. So let's go to the next slide.
No, really important. So every year we get to give away more. We love to hear that. So this is gift and estate tax. So now in 2023, we can give away $17,000 a year to any individual
We can give more, correct?
Oh, we can give more, but it goes towards our applicable amount for in this case, the $12,920,000 per person.
So if I gave $100,000 to my son tomorrow, I would now have 12,820,000 as my estate and gift credit amount.
Yeah, don't you hate that when it happens?
Yeah, but it's $17,000. I don't even have to file a gift tax return.
No gift tax return, no notice to the IRS so that they can track it. You could stand outside the Super Bowl when everybody comes out and give each one of them $17,000. You don't have to tell the IRS about it.
Yeah, and as Don likes to state, I can give it to anyone and no one will ever know.
There you go. There you
Including
go.
the IRS.
That's pretty revealing, Don. That's all I have to say. But it does show that if you are over this amount, that the highest estate tax bracket now is 40%.
Yeah.
Which
And
is why you want to work with a planner and an attorney to make sure that your money goes to who you want it to go to, and the most of it goes as most as possible.
And
the reason it had come up was the discussion over the last couple of sessions that we've been doing. It has been, wait a minute, if I give my kid $17,000, don't they get taxed on the income when they received it? No, it was a gift.
Yeah,
Nobody
not
knows anything
considered
about it.
income.
And that's where the whole thing came from, is you don't have to report any of that or tell anybody about it.
That's
At
right.
17,000 or less.
That's right.
Yeah, and non-spouse, remember that. You know, if you're not a citizen and your spouse dies, then the income tax, notice the difference, how we
Big
treat
difference.
the immigrants.
Big difference.
You know, 12,920 versus 175,000. That'll
And, you
make
know,
you
that's
become a
something
citizen.
I often ask clients about, especially if I'm going to refer them to an estate planning attorney. I always ask about citizenship because we don't realize that that could be a variable that would have huge implications.
Yeah, and if you're lucky enough that if you're a married couple, this is doubled, correct?
Exactly.
So
Exactly.
And then the highest, if you're over that, you know, that's a hefty chunk to pay, 40%. But
Yes, it is.
again, there's lots of, the estate tax is almost a voluntary tax. If you don't do anything, yes, and you have a large sum of money, then you're going to give back to the government some of that money. What was I going to say? The IRS has their analysts, their agents in the estate and gift tax area has been dramatically reduced because there's very few people who have, as a married couple, 25 million, or an individual that has a close to a $13 million estate. So every year, less than 1/3 of 1% has to file in what they call a 706. Now, in 2025, what's going to happen?
Well, this is all going to revert back to the old rules.
And the old rule is going to be?
Was it 600,000 per person?
No, it's going to be somewhere between 5 to 6 million.
5 to
It's going
6
to be the estate and gift tax area.
And it makes it, but that makes a big difference, especially anybody who owns real estate in nice neighborhoods.
Yes, especially here in California.
Yeah.
So there's a thing called portability. So if you're in the 12, if you're over the 7 million, let's say $6 million estate income tax, the estate and gift bracket, you need to ask your attorney about portability when one of you dies.
Yes.
It's very, very important because you literally, if I die and I have a a $10 million estate, but I don't file an income tax return, a final estate and gift tax return, then my wife only has then the 13 million. But if I file a 709, I believe it is, Don, correct me if I'm wrong, because Don
706.
the 706, the voice of God, I love him, then because of portability, my wife gets an extra $2 million to $3 million added to it.
And incidentally, I seriously doubt you, the dead person, deceased would be a more polite way of putting it, would have been the one who was filing that. But where this has come up recently is that with this level of exemption that we have of almost $13 million, most people aren't going to use up anywhere near that amount. And if you do not request portability, then what's left out of your allowance goes away completely. If you use a 706 to request portability, the amount left, and I'll make this easy, if Pete was going the other way, I'm going to say if you use 2.9 million of it, then 10 million of your exemption is floating out there. If you use a 706 within 5 years of the death of the individual, then, and yes, someone has to die, that question came up. If your spouse passed away within the last 5 years, request portability, because then in 2025, when the limit, let's say, drops to 5 million, your portability amount stays. The IRS has said we will not claw back that amount and reduce it, which means that's saved, because otherwise both of your allowances are going to drop down. But with portability, and it's an automatic thing, if it's requested on a 706, some people say, well, I don't need to submit it if I don't have an estate. That would get you portability. And yes, it will take some money. You have your accountant, not your lawyer, do that form. But that's a very significant estate planning tool, especially after 2025.
Yeah, 706 return is a very arduous tax return, and you expect to pay somewhere between $5,000 to $15,000, depending on how complex that return may be.
There is, however, a possibility now that you will only have to fill out the portability section, which will greatly reduce it, but it still has to be done. So.
Nice.
Yeah, so you can't let that go. So again, it's important to know your net worth.
Absolutely.
It's just, especially when you win the lottery.
It could happen. Buy a ticket. Buy a ticket.
It's the next slide.
So we've been talking in conclusion, you want to look at your total return of what your investments are giving you and how they could be taxed. You may not be somebody who needs municipal bonds that are tax-free, depending on what your marginal tax rate is. Be very careful. Your traditional actively managed mutual funds, they really belong in a retirement account because they throw off a lot of distributions under law. They have to throw off any capital gains or income that they have to the shareholder every year. So the shareholder pays the taxes on it. If you have that in a taxable account, you may be very unhappy come tax season. So where you locate, what kind of investments you use and what kind of accounts you locate those investments in can have great tax ramifications for you. You want to be very careful of that.
Yeah.
And then we've been talking about annuities and how disruptive they can be. They also can be one of the most tax inefficient products. They can really transform capital gains into ordinary income.
Which is not what you want.
Yeah, you take income out of an annuity, it's ordinary income.
Yeah.
So I'm going to ask the question that just came up. Are SEP, so self-employed pension, and traditional IRA contributions tax credits or deductions?
If they are a traditional contribution item, a traditional IRA, not a Roth IRA, a traditional SEP, not a Roth, then you get a reduction of your taxable income.
Because the amount you put in is not included in your W-2 or whatever you have, because you didn't, and that's why when it comes back out again on a traditional IRA, it is ordinary income because you did not pay any tax on it when you put it in.
That's exactly right.
Right. Yeah. No capital gain on IRAs.
Tax break, but he wants to get paid.
Yeah. So.
And that's what, and Don, you bring up a good point too, because most individuals will say, okay, I'm supposed to save, so let's do a regular IRA. Well, if you're in a very low income tax bracket, why put it in a regular IRA? Put it in a Roth IRA. Because now, if you're young and you have a low income, now that Roth IRA is going to grow over 20 and 30 years.
And you
when
get to
it
take
comes
that money out tax-free.
yeah, and when it comes out, it's tax-free. So just because you get an income tax deduction doesn't mean it's good for you. People have these phrases that they kind of hang on and go, okay, tax-free, it must be good for me. Oh, I get an income tax deduction. That must be really good for me. And we've had people come up and say, gosh, I don't want to earn any more income because I have to pay taxes on that. Really? Even at the highest tax rate, you're still only paying the 40%. The rest of it is still income. So paying taxes means that you are earning money and you are receiving money. So
it's a first world problem.
yeah. So one of the things that I wanted to do, is this the last slide, Delia?
No, actually, I have slides on some new tax laws.
Okay, let's go
Secure
through
Act.
those. We have about 20 minutes left, I believe.
So real quick, we've got changes that were passed in the end of December for people who have to start taking required minimum deductions from their traditional retirement accounts. Now that ultimate age has been pushed out to as late as 75. Used to be 70 and a half. Now for a lot of people born between 1951 and 59, it's age 73. Those born 1950 or earlier, it's now 72. So lots of different ages that we weren't thinking about before.
Well, that's one of the reasons too. I think it's so important to do some financial planning because people don't know how much they could spend and be assured that they have the money over their lifespan.
That's exactly it. And you need to know that once this starts happening, then that's taxable unless you use some strategies for charity that could help you reduce the tax impact of these required minimum distributions.
Or just having it written down on a sheet of paper and saying, okay, if I spend $40,000 a year, I'm pretty assured that I'll have money for the rest of my life, even if I live to be 100. How long do you have your clients live till?
I typically ask them about their health and their family's health, but I typically go to 95.
Okay.
Although I had somebody come in and say he'd just gone to his father's 100th birthday party.
So you had,
I had to do something about that.
I think you have to have your clients live till 100, at least on paper.
I think you certainly might have to. I mean, the good news is we're living longer and the bad news is we're living longer.
Yeah, we've got lots more. We have a whole session on medical planning, just exactly because of that issue.
So there's another thing that came out of the Secure Act, and this is for people who put money into college savings plans called 529 plans. A lot of times people are hesitant to do this, whether it's parents or grandparents, because they're afraid the kid won't go to school, won't go to college, and they won't be able to use the money for the child in college. Now it turns out that those 529 plans that have been open 15 years or longer, you will actually be able to convert up to $35,000 of that money to a Roth IRA for that beneficiary of that 529 plan. So something to tuck away and think about. I want people who are actively contributing to 529 plans or thinking about contributing to know that there's another thing that they could actually do with that money to benefit that beneficiary.
Great idea.
Pretty
another one of
interesting.
those kinds of conversations that you have with the grandparents and the grandchild and say, hey, this is something that you can do.
That's
Because
exactly
it doesn't, you don't have to be a parent You could be anyone to contribute to a child's 529 plan,
Yes,
correct?
you can. I contribute to a friend's grandkids 529 plan.
It's a wonderful gift.
It's a great gift. And then we have to talk about the wonders of qualified charitable distributions, because for people who want to take money out of their retirement accounts and not be taxed on all of it, you can divert some of it to charity. That $100,000 limit that has been true up until now is now going to be indexed for inflation beginning in 2024. There's some other tricks that you can use with money coming out for your retired minimum distributions. You could actually take a one-time opportunity to take $50,000 of that to fund a split interest entity. Now, a lot of times that's not going to be really useful at just $50,000 level for a charitable remainder trust or an annuity trust. Might be useful as a charitable gift annuity.
Yeah, the charitable gift annuity, I just want to put a plug in for that. It's totally different than a commercial annuity.
Yes.
So it allows you to receive income based on your age, and the fact that you could take it out of your IRA that has never been taxed and put it in a charitable gift annuity, which is not going to be taxed, and be able to receive income from it, is something to look at if you need some higher income than what you're receiving.
Yes, and the older you are, the higher the income.
Yeah,
I don't know if you have a slide on it, Delia, but why would someone want to do a QCD?
The qualified charitable distribution reduces your tax on your required minimum distribution. So let's say that you have an IRA, you've reached that age where now you have to take out $18,000 a year. I'm thinking about one of my clients. She doesn't need that $18,000. She's blessed. She doesn't need it. She's towards the end of her retirement and she likes to give to charity. So if she took that $18,000, it would be totally taxable to her. But because she gives most of it to charity, only the portion she doesn't give to charity is taxed.
So in other words, she tells whoever's managing that account at some time during the year, it doesn't have to be at year end, write a check to this charity. Any true, honest 501c3, write a check to them. So the check has to be payable to them. My recommendation is have that check be mailed to you, to that person, not to the charity. When you get it, make a photocopy of it so that you have proof that it was in fact paid. The check is payable to the charity. You can't cash it. Then you mail it to the charity with a note that said, I'm giving you money, because they may not know it when the check suddenly just arrives. But this is 100% deductible because it
Wonderful.
reduces your income.
It
You don't have to
reduces
be,
your income.
you don't have to do itemized deductions. Standard deduction, perfect. This reduces the amount, which may also then reduce your Medicare bill.
Or
And that's
Exactly.
where all of these come together. But if you are charitably inclined and you don't need the cash, this is the best thing you can do. And yes, it's nice having the, charitable gift annuity and other things. This is 100% deductible because the income is removed.
That's exactly it. And some entities do it a little differently than others. Vanguard will send you the checks to sign so you can make copies.
Yeah.
TD Ameritrade will give you a checkbook and you write the checks. But you've made a really good point, is that you have to keep really good records, because the 1099 that you get out of your retirement account in January is not going to say, oh, you took out 18,000, but 15 of it went to charity. Oh, we'll
No.
only tax you on 3. No, the 1099 doesn't know that.
Right.
Does
So
not
the
know that.
1099 will say 18,000. You then have
Yes.
to be able to justify it. As some of the firms
Have the
also
records.
send out a statement that these are the ones you paid. But to protect yourself, because I tend to be very cautious, is make a photocopy of it so you know what it is, and then give it to the charity.
And I recommend that you write those checks probably no later than the first week of November, because I've seen some charities, believe it or not, be slow to receive those checks and log those checks. And sometimes if the client wrote it at the end of the year, it doesn't get really logged until January by the charity. Doesn't happen that often, but you have to be careful about it.
There's a question that is, do these records or checks have to be saved indefinitely? No, only 7 years,
Yeah.
which is the tax requirement. But so the answer to the question is 7 years which is all you need to keep your records anyway. So there you go. Thank you.
Yeah, and again, another tax implication of your investing. We already talked about active mutual funds, but you need to be aware, are you buying and selling inside a taxable account where every step that you take is taxable? Are you just going to hold passive mutual funds or index funds like an exchange traded fund in a taxable account where you're not going to be taxed on that until you sell it? And they are very tax efficient. They may throw off some dividends, but they're very tax efficient. You have to be aware of all these steps that you're taking in your financial plan and how it may relate to your taxes. So we've already talked about how you could get a deduction for a contribution to a retirement account and your earnings grow tax deferred. California doesn't tax Social Security. Municipal bonds are usually tax-free, both state and federal. And, you know, there's money that you need to put away. As Pete said, how much money am I going to need to generate a certain level of income? And it really depends on how you're invested and what inflation is all about and how much you need to save to get to a certain level. Here are the dates of when Social Security would be at your full retirement age. So if you were born between 43 and 54, you reach a golden amount of Social Security, kind of a sweet spot at age 66.
You know, I was thinking even Social Security requires some number crunching. I mean, you know, you could take Social Security between 62 and
70. It
70.
stops growing at 70.
Yeah, you know, just how do you do this all?
And this is a very big question that people bring to their advisors when we're doing retirement planning is when's the ideal place to take point to take Social Security?
You know, and what I hear is that men, because they believe they're not going to live very long, take it sooner. Women, on the other hand, you know, are more cautious and analyze things a little better and don't make as quick and rash decisions as we men do. They tend to hold off and extend it out, because I understand is that after the age of 65, you basically earn 8% per year.
Your full retirement age, after your full retirement age, you earn basically 8% a year. Your benefit will grow 8% a year, which is divided by 12. Every month you wait after your full retirement age, you'll get a little bit more.
Yeah. So health is important for you to know as to how long you're going to live.
Plus the benefits if you predecease your spouse, if you're the higher wage earner, what benefit would your spouse receive?
Yeah.
All of this is really critical to retirement planning.
And then you have to figure out your Medicare bills.
Oh my gosh.
Anyway.
So here's the amount that we could receive if we were filing this year, if we were retiring this year. At full retirement, the typical retiree might get about $3,600 a month. If you waited until 70, 45, 55 a month.
Yeah.
So
hang on a minute, back up one. So if I work past 70 and contribute to Social Security through wages, will your monthly Social Security payment go up after the 70-year-old bracket?
No.
If you've already filed, it could, and you're still working, it could be that it would be adjusted, that the extra income would be added to some of those years where you didn't reach a higher bracket, you didn't pay in a full amount to Social Security. So I've heard of people who have waited to take it at 70, they're still working, and about once a year, they get kind of trued up with Social Security and they say, oh, we're going to give you a little bit extra. You know, here's $15 extra a month.
So the amount of the increase in Social Security would be due to your earnings.
That's correct.
You had high earnings at 70 years old and you had low earnings early on, therefore it's increasing. You would not get the 8% a year.
You know, the 8% a year stops at 70.
Right.
Stops at 70.
Okay, thank you.
And you know, it's also difficult when one spouse dies,
Oh,
or you get or you have multiple marriages. I mean, stuff just isn't easy, and it's very individual.
Yes,
can't
I mean,
just
you
say-
could retire and have minor children and they would receive half of your Social Security and benefits.
Yeah, it's just not, there's just not one general rule where you can listen to a lecture and say, okay, now I know what I'm doing. It's very,
Exactly.
very individually driven of your circumstances.
Yes. So we've already talked about financial planners. They could be certified financial planners. They could have a designation from the
Yeah,
insurance
let's go.
industry.
Move forward on this.
And here's how you might find a good planner. You could go to the Financial Planning Association, read
I
their,
would recommend highly NAPFA.
yes, the
uh,
national, these are the fee-only planners.
Those are the fee-only planners. And they, when you go to that website, they'll tell you just all you need to do is plug in your zip code, and it'll give you the planners that is around that zip code. I use
Exactly.
this all the time. If somebody recommends or wants me to recommend a financial advisor, this is where I go. Very, very, very good.
So that's the end of my slides.
That's the end of your slides. Don, come on back up. Can we go over as to what we're going to go through in the next 5 weeks?
Yeah. Yes, I closed it. I'll bring it back up. Hang on a minute. We'll get
Okay.
there. Your money, yes, okay. And I want to do this, and I want to do this. Hang on, let me get down here.
And I see we got one more question. No, we don't.
That was my 5-minute warning.
Yes.
Yeah, hang on a minute. This is not quite as quick as we would like to have had it.
And
So let's
and the other thing we
talk
talked
diligently about something for a moment while I
Sure.
get this thing.
And one of the other things that we were talking about was, is there in the future going to be a possibility where people can,
Don't go there.
huh?
No,
Don't go there.
No, I would like
Okay,
you not
then
to
the
go there.
answer is
please.
no, Delia.
Wow.
Never
this is-
mind.
My screen just went absolutely berserk. I'm sorry.
Okay.
This is not
I
exactly
think-
what I wanted this
I
thing to
think
do.
what's also important for people to know, however, when they're thinking about retirement planning, is you need to know how much it costs you to live and whether that's going to change in retirement.
Yeah, it really is truly important.
So Pete,
Yes.
Pete, here's your thing.
So next week, we're going to go through Financial Planning 1. We got an excellent financial fee-only advisor who's going to do it, Lori Juskins. How do you pronounce the last name, Delia?
You know, I try never to do that.
And she'll introduce herself next week about this time.
Yeah, and we're going to go through the whole thing about putting together a net worth statement and cash flow, and just really the basics of
Yeah,
financial
Lori's
planning.
great. Lori's great.
Then we're going to bring in a medical expert just on medical care planning. One of the major expenses for individuals at the end of their life is just caregiving costs, long-term care. So how do you plan for that? So this potential expense. Then in week 4, we're going to talk about the investment world, how it is today, the free lunch programs, annuities, partnerships, oil and gas, commodities, etc. How is the investment world today? Then we're going to go back through and talk about equities and fixed income. You need both in your portfolio. And then the financial planning 2, we'll wrap it all up. And Laura Tarbox will do that one. And we'll talk about all of the previous sessions and kind of do an overview. So I want to thank you for being here, Delia. I really
Thanks for
appreciate
inviting
it.
me.
And everybody who participated. We're doing this both on Zoom and in live actions. So if you want to invite other individuals to attend, because we're going to get into the heart for the next 5 weeks, make sure that they go to the website first to register. Because unless you're registered, we can't send you a link so that you can participate. Don,
Or to be honest with you, if you
Right.
send them your link, you could both come in
okay,
because we did not restrict that. So
okay, good.
it's better to have them registered so that they know it and they get their own announcement. But
Yeah.
just as a note, if you can do it.
Q&A, we got another.
We're good. Thank you very much. So
Thank you.
this is,
Don, do you have any other
since we are
last-
timely in terms of what we do, it is now 11:30. And so this has been It's Your Money Week 1. We will be doing this for the next 5 weeks as we go along for money. And as of tomorrow, we begin It's Your Estate and we go through the week for the 6 weeks for that time. So Delia, thank you very much. Pete, thank you very much. And the camera is now.